Is your Indonesia exposure as transparent as you think? Here's why a fresh MSCI signal could reshape how capital flows into Jakarta-listed stocks. MSCI has put Indonesia's equity market under the microscope for transparency. That means governance, corporate disclosures, and trading practices are being watched closely. For global investors, this matters because MSCI benchmarks drive index construction, ETF allocations, and passive flows. If market accessibility changes, index weights, and even which companies qualify can shift, moving real money. The core issue is clarity. Investors need consistent, timely company reporting and predictable trading. In a market tied to a fast-growing economy and a massive population, small frictions can translate into wider bid-ask spreads, pricing gaps, or unexpected index changes. MSCI's latest assessment keeps transparency under review. That signals lingering concerns around disclosure quality and the visibility of trading. It also raises timing sensitivity. By flagging conditions ahead of scheduled index reviews, MSCI is effectively starting a countdown for measurable progress. The lens is sharper too. Accessibility of market data, comparability of corporate reporting, and availability to international investors are getting more weight in the evaluation. Remember how MSCI shapes portfolios. Its standard indexes aim to cover about 85% of each market's free float-adjusted capitalization across the 11 GICS sectors. That 85% target defines what's investable for many allocators. If Indonesia's accessibility is questioned, constituent eligibility can change, and ETFs benchmarked to those indexes must rebalance. Sector tilts, factor exposures, and country weights in global and regional strategies can all move. For investors, the practical takeaway is twofold. First, monitor MSCI communications and the semi-annual index review cycle as catalysts for flows. Second, stress test your Indonesia exposure. Consider liquidity, disclosure consistency, and corporate governance signals within your holdings. If you use ETFs, check their underlying index methodology and watch for potential reweighting. If you hold single names, reassess information quality and trading continuity. Hedging and position sizing should reflect the chance of index-driven volatility. This is not a call to exit Indonesia. It's a call to tighten process, use watch lists, track company reporting cadence, and engage with managers on how they handle evolving accessibility criteria. The goal is to maintain fair pricing and confidence while staying aligned with your risk budget. Want the deeper context and what to watch next? Read the full article at finlitica.com. Quick reminder, this is general information, not financial advice. Your money, your decisions, so always do your own research.